Back in the 1950s, a sociologist named Alfred Winslow Jones had an idea that would change investing forever. He wasn't a Wall Street banker or a stockbroker, he was a thinker. And what he created was the very first hedge fund. Now, what does hedge actually mean? Simply put, it means protection. It's like when you buy a plane ticket with travel insurance, if the flight does get canceled, you lose the ticket, but the insurance pays you back some of that money. Jones applied this idea to investing in placing bets on companies to succeed and betting against others to balance the risk. But fast forward to today, and hedge funds have become pretty much the exact opposite of what Jones intended. They offer high risk deals behind closed doors, wrapped in massive fees where only a selected few are allowed in. And today I'm going to pull back the curtain on how modern hedge funds actually work, how the managers get rich even when you lose, and why I choose to put my millions into concrete and dirt instead of the Wall Street's private casino. So looking back, you guys, to the 1929 crash. So in the 1920s, investing, it was a casino. People bought fake companies that led to the 1929 crash. And then Congress, it created the SEC, which is the Securities and Exchange Commission. And their job was to force transparency. So if you buy a public stock today, you get real data. And the loophole here is that hedge funds completely opt out of these rules because they only accept accredited investors, people who are wealthier. And the government assumes you can afford to lose your money. So there is zero oversight here. Investing in public markets like an S&P 500 index, it's a lot like fishing off a crowded dock. Everyone can see your bait, and the water is clear. Hedge fund is a submarine. They're going to dive into deep, dark waters with zero transparency. And the manager says, trust me. And then they lock your money up for a year. You know, a big separator between hedge funds, which operate with zero transparency, and, private firms like syndication firms or family offices that invest in real estate where there's total transparency, right? You'll get an update from us that will show exactly what's going on in the asset. What do we do for CapEx? What challenges have we been through? What successes are we having? But you'll get a full set of financials and you'll be able to see exactly how the income and expenses are performing compared to what we projected. Whereas with a hedge fund investment, you're never going to see that. You're going to have to take the trust from your hedge fund advisor and assume they're being great and fiduciary with your capital and returning it in a positive or agreed return. Beyond that, you're flying in the dark. And so you got to wonder a little bit, why is it that people would hand millions of dollars to a hedge fund investment or advisor when they have zero transparency of what they're doing? For those of you that don't know, the heart of almost every hedge fund is the 2 and 20 fee structure. And what that simply means is the manager charges a 2% management fee, and that's just for holding the money, and then a 20% performance fee on the profits. And the reality with that is that the house, they always win. Let's put real numbers on this. If a fund manager manages $1 billion, they're going to collect $20 million a year in management fees. That's before you make a single dollar of profit. If they lose your money, it's 100% your loss. So the manager still walks away with their $20 million of salary. Over the last decade, many of these funds, they've failed to even beat a basic S&P 500 index fund after those massive fees are taken out. So the risk really is put 100% in the investor's court here. And look, I know a lot of you are watching this at different stages. And for those of you that are just learning, that's great. Keep watching, grab the free blueprint, educate yourself. But some of you are past that. You already know this makes sense conceptually. You just need someone to look at your specific numbers and tell you what actually applies. That's what our capital positioning call is for. If you're an accredited investor and you want to have a conversation with my team about how your capital is positioned and what real estate could look like in your portfolio, we've got a few spots open this quarter. Links down below. In comparing the hedge fund world to private investments in real estate, a hedge fund manager that's managing $1 billion can fail completely and still walk away with 20 million of profit. Whereas if you get with a great syndication firm or you get with a great real estate investment firm, they should have money in every deal right alongside you. I'd say 10% of the capital raise should come from the general partnership team. So if you're raising $20 million, $2 million should be coming from the general partnership team, right? And that right there just makes sure that the party that's operating the deal, that's running the deal, has alignment with the limited partners, has invested interest, so that if the deal does go haywire, if things do go south, yeah, the LPs are going to lose, but so is the general partner. And they're probably going to lose a lot more because not only are they going to lose the capital, but they've just invested a ton of time into a deal that didn't profit, and their reputation is definitely going to take a hit. The big difference, you guys, is you're looking at hedge funds being paper bets versus hard assets. So hedge funds, they bet on abstract concepts. They're looking at Japanese interest rates, natural gas spreads, whereas real estate syndicators are buying physical, essential housing. And that's a big difference of control. So in private equity real estate, we aren't guessing what the market will do. We're going to force the value up ourselves based on real market fundamental data that we can see and verify in the submarket. The separator for me is it's the alignment. Real estate investors are going to rely on the property's actual performance to hit their promotes based off of what they can do with the asset, based off of real data right now. And that's data that anyone should be able to verify. This isn't secretive information. This is stuff that the real estate investment group should be giving you. We found this data. Because of this data, we can say that this is what's coming in the future. Here's what we've done on previous assets over the last 6 or 12 months. We're going to recreate that story right here. We're going to recreate those value add opportunities right here. That's the separator right here. If I got 100 grand I'm looking to invest, and I can either put it into Wall Street and hope and trust some hedge fund manager versus something that's real, that's performed well when inflation's ripping, and someone who I can get to know on a personal level, an asset I can go see and touch. Once I have that relationship with that operator, I feel 10 times, 50 times more comfortable putting my 100 grand in with that operator, where I can actually track, can verify how's the deal doing, can go and touch it, can go and drive it, can go and see the asset. I can go look at history and I can see that value add real estate in an inflationary market like we're in is a phenomenal way to hedge inflation. And it's the lack of transparency that's got me concerned with these hedge fund managers. Like, if I don't know where the money's at, I don't know what they're doing, and these derivatives explode like we've seen, how quickly can my money be evaporated overnight? It's just too risky in my book. So hedge funds, they started as this brilliant idea to protect capital, but as time went, they've evolved into this exclusive casino where the manager is the only one as a guaranteed winner. You don't need to invest in secret, complex algorithms to get wealthy, you guys. The real secret of ultra wealthy is actually incredibly boring. They own hard assets, physical assets that produce cash flow month after month, year after year. Stop paying for their yachts and start building your own wealth. I'll see you on the next one.